let's talk about taxes on stocks. Today, I'll be giving a complete overview on the subject. We'll be covering when you have to pay taxes, how to calculate how much taxes you have to pay, and how to lower your tax liability. Even if you're new to stock investing or taxes, this video will be extremely easy to follow and understand. But before I do, make sure you like this video so others can find it on YouTube, and subscribe so you don't miss other videos that can help you reduce your taxable income. Okay, so when do you have to pay taxes on stocks? There are two ways you can be taxed on a stock. The first way is if you sell a stock or security for a gain. If you sell a stock that you held for less than a year, you will pay what we call short-term capital gains tax. The short-term capital gains tax rate equals your ordinary income tax rate, aka your tax bracket. If you sell a stock that you held for more than a year, you will pay long-term capital gains tax. The long-term capital gains tax rate is 0%, 15%, or 20% depending on your taxable income and your filing status. Here's a look at both short-term and long-term capital gains tax rates depending on your tax bracket. In short, in either scenario, if you end up with a profit from the sale of stocks at the end of the year, you will have to pay taxes on the profit, also known as your capital gain. Okay, let's talk about the second way you can be taxed on a stock. The second way you can be taxed on a stock is if the stock you hold pays dividends. Dividends are payments made by companies to investors who hold their stock as sort of a bonus for holding. An example of a company that pays dividends is CVS or Lowe's. Now, there are two types of dividends, ordinary and qualified, and they are taxed differently. Ordinary dividends are taxed at your ordinary income tax rate, aka your tax bracket. Qualified dividends are taxed at long-term capital gains rate, which is, remember, 0%, 15%, or 20% depending on your taxable income and filing status. Here's how to know if your dividend is considered qualified. First, they must be paid by either a U.S. company, a qualified foreign corporation, aka one incorporated on U.S. soil, or whose country signed an income tax treaty with the U.S., or their shares must be traded on an American exchange. Second, they must not satisfy conditions the IRS lists as dividends that are not qualified dividends, which include capital gain distributions, dividends from tax-exempt corporations, and payments in lieu of dividends, to name a few things. And lastly, an investor must have held the stock for more than 60 days in a 121-day period that starts 60 days before the ex-dividend date. Note that reinvested dividends are treated as if you actually received the cash and taxed accordingly. Now that we know the two ways you can be taxed on stocks, let's discuss how you calculate how much taxes you have to pay on those stocks. Here's a simple 4-step process to do so. First, determining how much profit, aka capital gain, you receive from the sale of a stock. Second, determine how long you held the stock before you sold it. Third, determine how much capital gains tax you will have to pay. As mentioned previously, this will be determined by how long you held the stock and your tax bracket for the year. Lastly, calculate your tax liability by multiplying your capital gain, aka your profit, by your appropriate capital gains tax rate. That was a lot, so let's walk through an example. Let's say I owned a stock for 366 days, more than a year, before I sold it for a gain of $3,000. With just that information, we cover steps 1 and 2. Determine profit, $3,000, and length of ownership, more than a year. Next, let's say that I am in the 22% tax bracket. From the information we know so far, we know that because I held the stock for longer than a year before I sold it, that I will pay long-term capital gains tax on $3,000. Also, because I am in the 22% tax bracket, we also know that my long-term capital gains tax rate is 15%. Remember our formula? Capital gain times capital gains tax rate. With that formula, let's calculate our tax liability from this sale. We take out $3,000, aka our capital gain, times 15%, aka our long-term capital gains tax rate. This equals $450 I have to pay in taxes. Now that we know how to calculate how much taxes you have to pay on stocks, let's discuss ways to lower your tax liability on stock selling. The most obvious way is to hold your shares for longer than a year, so you can take advantage of long-term capital gains tax rates. The second way to minimize your tax liability is to use your capital losses to offset your capital gains through a process called tax loss harvesting. I made an entire video on that subject alone that I will link in the description for you. In short, when it comes to capital gains from the sale of a stock, you can offset 100% of those losses to the gain. And if you don't have any gains at all from the sale of your stocks for the year, you can use up to $3,000 in losses to offset up to $3,000 of ordinary income for the year. This changes to $1,500 if you're married, filing separately. Alright, here's a third way to minimize your tax liability. You can choose qualified dividend stocks over ordinary dividend stocks. And the fourth way, dividends and capital gains on stocks held inside a traditional IRA are tax deferred and tax free if you have a Roth IRA. There you have it. That's all, folks. A complete overview of taxes on stocks. If you found any value in this video at all, go ahead and smash that like button for me. And if you have not subscribed already, go ahead and subscribe so you don't miss any video that can help you save on your taxes. I'm Karan from Life Accounting. Until next time.